In this video, we're going to look at Metro grocery stores. And Metro is the third largest grocery store chain in Canada. And what I do in my videos is I try to figure out the actual stock price using financial information and also looking at the capital structure of a company. I also look at the financial ratios and compare them to similar companies. So let's get started with the model. This company has a market cap of $14.2 billion. And they're trading at $56.45. Next, we need the free cash flow. And the way you value a company is you estimate the future free cash flow and you discount that number back to today. And free cash flow is the cash that's remaining after operating your business. And we're going to also need the net income, and that's on the income statement. And that's the profit and loss for the business. And next we're going to pull the revenue, which are just the sales. The model does all the calculations. And as you can see, the numbers look pretty consistent, so we should get a good value. In 2018, they had a 12% profit margin. And in 2019, they had a 4% profit margin. So you can see in 2019, they had $2 billion more revenue, yet they had $1 billion less of net income. So we need to delve into the income statement more to figure out why that happened. But for the sake of this video, let's just move on. We need their capital structure so we know what to discount the future cash flows by. They pay $108 million of interest on their debt, and that's on the income statement. And then we'll go to the balance sheet to find out how much debt they have. Go to the liability section. Current debt of $428 million. That's debt due within 1 year. And then long-term debt of $2.2 billion. That's debt due after 1 year. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement. The income before tax is $969 million. And the income tax is $254 million. So their effective tax rate is 26%. So the cost of debt is 3%. Let's get the cost of equity. So we need the beta. The beta is how volatile the stock is relative to the market. So they have a beta of negative 0.12. So the stock actually moves in reverse of the market. So if the market goes up, this stock would go down. If the market went down, this stock would go up. Let's get some more information from the balance sheet because we need to look at their ratios later. So we need the current assets. Their current assets are $2 billion. Current assets are mainly cash, accounts receivables, and inventory. Let's get their current liabilities. These are payables and debts, which are due within 1 year, and that's $1.9 billion. And their stockholders' equity, which is assets minus liabilities, and that's $6 billion. And we'll pull their EBIT, earnings before interest and taxes. It's called operating income on the income statement. That's $1 billion. So let's look at their capital structure. So the cost of debt is 3%, and they have 31% debt. And the cost of equity is 1.4%, and the weight of equity is 69%. So the weighted average cost of capital is 1.9%. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the company of $18.5 billion. We divide that by 252 million shares, and we get an intrinsic stock price of $74. So according to my model, it's saying the stock is worth $74 today, even though it's trading at $56. So it's trading at a 24% discount, so it's a buy. Let's see what Simply Wall Street says the stock is worth. They say it's $61, so they're saying it's a little less than what I'm saying, but in both cases, we're saying the stock is a buy. It's undervalued. Let's look at the historical stock price the past few years. So it looks like the stock hasn't been affected at all by coronavirus. It's just been increasing little by little every year. It's almost at its peak now, so it could be a good time to buy, especially grocery stores. They're in high demand. Let's look at the financial ratios. They have a PE of 20.0. That's price of stock over earnings per share. That's a little high. I like to see under 15. Price to sales ratio of 0.8. that's price to stock over sales per share. That's a good ratio. Price to book of 2.4, that's price to stock over book value per share. That's a good ratio. I like to see under 3.5 for price to book. Current ratio of 1.1, so that's good. They can cover their current liabilities. ROE at 12%, that's income over equity. They don't provide the greatest value to the equity holders. I like to see above 20%. Interest coverage ratio of 10, that's EBIT over interest expense, so they can easily cover their interest. Debt of 31%. Let's compare them to ATD, another grocery store in Canada, and if the number is in orange, that means their ratio is better than the other companies. So Metro has a better PE, price to sales, price to book, current ratio, and debt when compared to ATD. ATD has better ROE and a better market cap. So let me know what you think of the video. Do you invest in grocery stores? Thanks for watching.